Okay, folks, let's get the show on the road a bit earlier than usual. Okay, this is the Fife Property Market update for the last week from the 3rd of December to yesterday, the 9th of December. Looking right across the whole of the Fife Property Market with all the estate agents have listed in any particular area in Fife. Now, we break it down to places like Cooper, East Neuk, St Andrews, Leavenmouth, Dunfermline, and Glenrothes and Kirkcaldy. So we have basically 7 fundamental regional areas in the Fife area itself. And it all tells a story about what's happening in the Fife property market. Watch out for the Boxing Day bounce. You know, this will be coming Boxing Day, apparently. That's what it says in the tin. And let's talk about as well about a show we did yesterday, Richard and I, about lettings and winter preparation for landlords or investors if you're out there, or even letting agents if you're listening in and tuning in right now, the tips that we can do. Plus, I'm going to talk about what is the property market in terms of the surprise the nationwide actually came out and says house prices have actually risen last month according to them by 0.2%. And what does that really mean according to the house price index as well? And finally, we're going to be talking about the wealth creation show and the pensions crisis is in the making. Ticking time bomb, pension crisis. Let me talk about that at the end and just hang on till we go through things. 15 minutes, we're done. Okay, let's get started. Let's look at the Fife figures right across the property market. Here we are last week in the regional areas. You can see Cooper 6 instructed with all the estate agents. I mean, it doesn't sound much, but remember, we're going into a quiet period. Well, let me just explain that. We're going into a quiet period, according to everybody, but you're only as busy or as quiet as your estate agent wants it to be. Just let me say that. I have sold a house on Boxing Day, on Christmas Day, on Christmas Eve, on New Year's Eve and New Year's Day, actually last year, in order to prove that point that you're only as busy and quiet as you want it to be, and it's really driven by your estate agent. So there's golden opportunities right now to actually get your house in the market and take advantage of the Boxing Day bounce, which means activity on the website's actually double from Christmas Day to Boxing Day because everybody starts to look at property because Christmas is now over. Start to focus on property itself, so you get a huge boost from that Boxing Day bounce. How long does it take your house to go on the market? Well, if somebody decided today to put their house on the market, we'd have the photographer, the creative content writer, the home report surveyor, and then the videographer round all at the same time. So that literally could be done in the next 3 or 4 days. Once the home report's done, your house can go on the market immediately on social media. 4 to 5 working days, it then hits websites. So you've still got time to get there for the Boxing Day bounce. There is no reason why you can't list in between Christmas and New Year as well and take advantage of the bounce for New Year, because it happens again. And I've often sold a house, listed and sold a house actually on Christmas Eve one time at the back of Anstruther. I did that. So it's just to prove a point that you can still sell houses at this time of year. There is still a good market. You're only as busy or as quiet as your estate agent wants it to be. Let's just jump back and I'll show you the numbers. So this is not unusual. 75 properties actually came on the market right through Fife overall, but 80 properties sold. So it just tells me again the Fife property market is resilient. There's more houses being sold than there is being listed. It's clear here, a totally different story than what we're getting told in the media. So you can see that right across the board. Obviously, regional areas are different. St Andrews, surprise, 1 instructed, actually 4 sold in the St Andrews area. Now, that's usually the other way around, so that's actually a big boost for St Andrews. Glenrothes, 8 coming on, 10 sold. Kirkcaldy, 16 versus 16, and you can see overall. Let's talk about actually what's been listed in the area from ourselves and actually what's been sold. Just let me get my notes. Okay, so listed and sold. This is actually 2 weeks. This sold in Creole. This is Tolbooth Wynd in Creole, sold in 2 weeks. This is a 3-bedroom terraced house, and that was listed at offers about 275,000. So these properties are actually real still in high demand. High Street Strathmiglo was another one. This is 6 weeks this told, so 1.5 months more or less. 2-bedroom semi-detached house listed offers 130,000. Invery Street in St Monans sold in 8 days. 3-bedroom ground floor flat listed offers over 135,000. First time buyer actually bought that. Bayview Crescent in Methil. Now that's sold in 4 days. It previously actually fell through because it's quite a low value, and they couldn't get a mortgage for a buy to let the person, so it actually came back on and sold again. 2-bedroom ground floor flat. It was offers over 37,500, so a real bargain out there for someone. Definitely an opportunity to add value, because these properties, 2-bedroom ground floor flats in mint condition, are going for about 60 or 70,000. So definitely opportunity to add value, and then get remortgaged, get all the money back out, especially if you're an investor, and then you've got a no money down deal and infinite return. Okay, finally, Balgari Bank in White Cottage in Bonniebank. Now, this actually took 9 months, but this was land, really. I know you see a building there, but effectively we were selling a plot here. It was listed at offers over 185,000, and the new owner is looking forward to the new project of building their new home. So perfect opportunity. So you can see all the price points here are actually quite low in comparison. Again, it goes back to saying it's round about up to 250,000 properties are actually going very, very well. Let me talk about what's coming soon. Okay, coming soon. Now, if you're interested in these properties, these will be going on between now and New Year. Grantminston, Stedding and Crail, 4-bedroom detached house will be going on. Main Street, Lower Largo, 1-bedroom ground floor flat going on. West Shore and St Moniz, 3-bedroom mid-terrace townhouse. I have actually done a pre-portal on that already. It's got a huge amount of activity on it. So if you're interested in that one, you probably need to get in there quick, overlooking the harbour. Roger Street and Cellar Dyke, a building with planning permission. That's Barnett's Bakery will be coming on. That's 4-bedroom, 4 1-bedroom apartments, planning permission for, and a 3-bedroom house. Sandwell Street, Buckhaven, 3-bedroom, semi-detached house will be coming on. Park View and Balmullo, 3-bedroom detached house coming on. Rosemount Grove, Leven, 3-bedroom semi-detached house coming on. Sun Close and Cooper, 1-bedroom ground floor flat. Ash Grove and Methil, 2-bedroom terraced house. Watch out for these ones. Again, all these people are going to take advantage of this Boxing Day bounce and get in there before anyone else. You can notice when I go back to the numbers that are getting listed, typically, let me show you this again so you understand what I'm talking about. In here, 75 properties listed with all the estate agents through. In fact, that's generally around about 120, which means if you're coming on now, you've still got all these people still looking for property. There's still buyers out there looking for property. So if you're coming on now, you're getting advantage and getting in there before anyone else. Again, it's all down to your agent if they're responsive enough to, cover over Christmas and New Year, if they're responsive enough to be on phones, being on the social media channels, and keeping an eye on that, other than just shutting down for 2 weeks. That's probably the key here in terms of activity over that period. Let's talk about completed over the line. This gives you a great idea about what was sold. In other words, what's been sold, keys handed over. We can tell you prices now in areas. Right, Craignoon Grove and Cellar Dyke was a 4-bedroom detached house. It did sell in 1 month, and it sold for the home report value of 335,000. Keir Hardy Street in Methil, 2-bedroom ground floor flat. It sold in 3 weeks for 6.6% over the home report value. So it went for around about 2,500 more than what it was on it. Orchard House in Orchard Grove in Leeton. This is a 1-bedroom upper apartment, and it sold in 10 days for 12% over the home report value, representing another £12,000 to the existing owner. So perfect for them. William Street in East Weems, 3-bedroom terraced house that sold in 2 months for 5% over the home report value, which represented another £7,000 to the existing seller. Covers the fees. That's exactly what you want to do. So you literally get us for nothing and get cash back in the exercise. What else could you, what better situation could you have? And that's perfect. So the circumstances are absolutely right. Let me just talk about the price rises. Okay, Halifax came out this week. Quickly, let's just jump onto the lettings winter preparation. If you're a landlord, we have a tenant checklist and a landlord checklist for warm and safe rentals on here. So you can read that blog, you can listen to the podcast that we did, or you can watch the show as well. More than welcome to do that. If you're a landlord or investor, or even you're a letting agent, you'll probably not know some of this because we put our own thoughts and opinions on this and what we would do normally. I've been in this for 35 years or thereabouts, so there's a lot of knowledge and information I've actually been using over the years, over and above what the article says, hence the reason why I've put it in the blog and the post itself. Let me talk about house prices. Right, let's talk on house prices. Nationwide came out and said a 0.2% increase in November. Now, I've never really relied on Nationwide and the Halifax Index. I tend to rely on the House Price Index, which is the UK House Price Index, which is all the data collated together, not just the Nationwide customers or the Halifax customers, because that's all they're doing on. And I tend to follow that one. But I also have our one on as well, because we keep an eye on real-time information. In other words, what our properties are actually on it in terms of home report and what they actually end up selling for. And that gives us an opinion based on facts which have actually gone over the line maybe 6 months ago and now concluded with the house price index for the UK house price index, also the Scottish house price index. And it also gives us real-time information about what's happening right now in the property market in Fife. In other words, what we're listing a minute, listing property at in the value and what they're actually selling it, and that gives us a great idea about is there actually a trend of house prices going down or house prices being stable or house prices actually going slightly up or way up into a boom market. At this point in time, I could see a very stable market. Some properties, as you've seen right there, I've just said to you right now, are actually going for over the home report value. Some properties are actually going for home report value, and there's very few properties that are actually going for under the home report value. If you're waiting for prices to fall, it's not going to happen. It's not going to happen. And let me talk about that in a wee bit more detail in terms of what interest rates and stuff like that, and why that is important. In mid-August, investors actually expected the Bank of England to raise prices to 6% in terms of interest rate rises, and then fall to around 4% over the next 5 years. By then, however, by the end of November, that's actually the views actually changed. With interest rates already peaked at 5.2%, 25%, and then continued to be lower over to about 3.5 over the next 5 years. Now that's what they're saying. I believe that interest rates maybe have peaked now, around about 5.25, the base rates anyway. But I do believe that base rates are, personally, I don't see any indicators that actually makes me believe that over the next few years, base rates are actually going to fall to 3.5%. We still have a full employment situation. Unemployment sitting at around about the 4% level, so it's still full employment in terms of economic terms. We still have inflation lower than what current wages are getting negotiated at in terms of wage settlements. So again, all that money is getting pumped into the system when these wages are negotiated. Look at the train drivers, for example. That wage settlement is still to be settled. Once that gets settled, that'll all more than likely get backdated, which will be a huge influx of money into the system, which will take up possibly and actually affect inflation. Hence the reason why I don't think base rates are going to go down as much as we think. However, the economy is running quite well, and Moody's and Standard & Poor's, who are the rating agencies, rate the UK economic situation as positive. Therefore, other banks on interbank rates, in other words, swap rates, which is what they use to determine mortgages, are the amounts are historically low in comparison to actual base rates themselves. That means overall that banks can offer mortgage rates lower than actually base rates, and we can see that happening right now, where mortgage rates and are a lot lower than actually base rates. You're getting some 5-year fixed rate deals at below 5% right now, and yet base rates are sitting at 5.25. That's because banks are lending to each other at a far lower rate. Therefore, they can get that margin of profit they need, but still keep it affordable for people to be able to get lending. Because after all, they want people to get lending. Banks are in the business of lending money. If they don't lend money, they're out of business. So they want to make it affordable for you as a mortgage owner and a mortgage holder to be able to get a mortgage so they can still make a profit in between, because that is their primary business. That's what they're there for. So it's in their intention to do that. Now, this is quite interesting because let me just say that the Nationwide's chief economist actually ends, nevertheless, and this is actually quite interesting as well. Nevertheless, he goes on to say that a rapid rebound still appears unlikely. In terms of cost of living pressures are easing, with the rate of inflation now running below the rate of average wage growth. but consumer confidence remains weak. And surveyors, in other words, home reports and chartered surveyors, are continuing to report subdued levels of new buyer inquiries. Moreover, while markets are projecting that the bank rate move will be down, there's still upward risks to interest rates. Inflation is declining, but measures of domestic price pressures remain far too high. So this is actually the Nationwide's chief economist actually kind of on the same lines as what I'm trying to say. It's interesting when they go on to say that policymakers have cautioned that it's too early to be talking about interest rate cuts. Indeed, 3 of the 9 members of the Bank England's Monetary Policy Committee voted to increase bank rate at its meeting in early November. So 3 out of the 9 still voted to increase base rates from 5.25 upwards. So although the remaining 6 prefer to hold at 5.25 for the time being. So this kind of goes in line where I'm thinking about in terms of, if you think base rates are going to come down anytime soon, I don't think so. I don't think that's going to happen. We're not going to see these historic rates that we've had before and these great rates that we've had before. But the saving grace is the fact that since 2014, all the banks have stress tested everybody, even at these low rates, at about 5 and 6% all the time. So because base rates and mortgage rates are at 5 and 6%, it still means that existing mortgage holders that are coming out of their deals can, under these terms that they've been stress tested, that can probably still afford what they're doing. The unfortunate situation is they've maybe got all this money and they've gone and committed themselves to other fixed expenditure. In other words, probably financing cars and stuff like that as well. So that's when they'll have to think, do I actually need that in order to maintain their mortgage rates when they come out? If you have got a mortgage rate coming out anytime soon, speak to your bank, because they'll probably give you a better deal right now than you having to wait. They actually say that quite openly. They can give you more than likely a better deal than when you have to wait, just in case. Banks are still really good at doing that. After all, they want to keep you as a customer. They still want to make a marginal rate, and swap rates for them are extremely low. Therefore, they can actually give you the benefit of that while still making a profit. Lastly, let me talk about the pensions crisis. Most people don't know about the ticking time bomb of pensions. I'm going to talk about it tomorrow on the Wealth Creation Show with Richard at 12:30. Now, I am not a pensions advisor, and I would never purport to be. However, there's specific signs there which give me an impression that, and I talked about it today on my blog when I was walking along the beach on my personal profile, and the fact that if everybody gets the same pension when everybody retires, everybody's going to have the same amount of money, everybody's going to have the same buying power, therefore all that money is going to go into the system at the same time, therefore inflation is going to come across, house prices will go up, mortgages will go up, food prices will go up, and utility prices will go up, and as well, rents will go up as well. It's a foregone conclusion. It's just happened with quantitative easing when all that money was pumped in through COVID. And when you see money getting pumped in the system, no matter where it's coming from, you've got to ask yourself, as Warren Buffett says, and then what? So what is the consequence of that happening next? And that's what you've got to think about, and that's what you've got to plan and forecast. So we're going to talk about tomorrow about the pension situation and what kind of the Times actually put out a recent survey, and this is what it's all based on. The Times actually talked about what it is to retire on what does a pension pot. I've got it here actually. What does a pension pot worth 37,000, 150,000, and 500,000 actually give you? You wouldn't believe, but the average pension pot, and this is according to Pension Bee, which I'm really surprised about. The average pension pot in the UK is 17,379 at this point in time. That's quite frightening. The average pension pot in Scotland is 15,194, according to Pension Bee. Now, how anybody could survive on that, I do not know, because that's a pot meant to be able to survive. Now, you have the state pension when you retire, but for people that are a lot younger, the state pension will probably disappear in the next 20 to 30 years. as it suddenly disappears, because that's why they're deliberately getting companies to take charge of that, to actually subsidise that overall. And that will continue to be pushed onto the responsibility of employers over the years. The government is broke, let's be honest. They have a huge financial commitment to things like the NHS, the police services, and everything round about, environmental impact, cost of living, everything like that, universal credit, housing benefit. They've got all these bills still to pay, and they need to bring tax in as a result. Therefore, they need people to work, but they also need people to save for the future, so their liability can be lessened later on. We all know it's coming. And we're going to leave a legacy for our children to end up having to pay for it. So this is why it's important to talk about pensions tomorrow. So we'll be talking about it. As I said before, I'm not a financial advisor. This is fact based on an article in the Times recently in September, which actually talked about what is it, what could you retire on comfortably, and what will you get for your money at certain pension price points. Okay, I'll see you tomorrow on the Wealth Creation Show at 12:30. Until then, it's bye-bye from me. Bye-bye for now.